I'm going to be talking about option income strategies and a lot of stuff that's involved with those strategies. So let's get started. First off, the following webinar is purely for educational purposes. Any stocks, futures, options mentioned does not constitute advice and should not be construed as recommendations. So yeah, I appreciate the opening introduction, and yeah, I've been actively trading for over 30 years and was previously the executive vice president of one of the largest oil trading companies in the world and ran all their international trading out of Bermuda for over 10 years. So it was a fabulous experience there, and pretty much if it moved at that point in time, we pretty much traded it. So I've been involved in trading all the various derivative markets, forex, a lot of foreign exchange, lots of crude oil. So, you know, been into all the different areas of trading, and started trading options back in the mid-'80s on cargoes of crude oil, and that was where I got introduced to it, and I've kind of had a passion for options ever since. Went on after this great experience to launch the institutional over-the-counter crude oil option brokerage desk for the largest privately owned oil brokerage company in the world, PVM Oil, and that was also another great learning experience. Learned a lot of different option structures and worked with a lot of the big institution banks and a lot of the hedge funds. So it's a really great learning experience there. So hopefully I'll be able to pass on a few little, you know, secrets and things that I've picked up along the way, and hopefully you'll come away with this knowing more than when you came in. First though, I'd like to kind of get a feel for everybody that's in the room. You know, how many of you would like to be more active in the markets trading and maybe as a full-time job, but you're not quite there yet? Just if you just put in a yes or no, just kind of like to get a feel for who all's here. Seeing lots of yeses there. And I just like to say, you know, I can remember exactly what it was like when I first started trading my own account. And, you know, I was actually very nervous about having my own money on the line. And it was, you know, such a different feeling than, you know, when it's your own dollar. And I've got, you know, a wife, 2 boys in college, a mortgage, and, you know, plenty of other expenses. So I really get it about having your own dollar out there. Now, when I was running the international trading desk, I found myself in plenty of nerve-wracking trading situations, but at the end of the day, it really didn't affect me personally unless I blew up my boss's trading account, which I never did, thankfully. You know, it wasn't my money at risk. It was the guy I was running the desk for, the owner of the company, and he was extremely wealthy. So, you know, I've made some major learning mistakes, and you know, during my learning, you know, when I first started trading my own account, I've had some major learning experiences trading this account, and some were not too pretty when I first started off. But you do learn from your mistakes, and I did learn, you know, very fast what not to do. Now, trading for my own account really improved once I started doing a better job of controlling my risk. And the huge breakthrough was really learning how and then committing to limiting my downside in any trade taken. Now, I do this by using options and option spreads. And a really big aha trading moment came when I started taking advantage of option premium collection strategies in my trading. You know, once I did this, it really became a totally different game for me, and I could, you know, actually sleep a whole lot better at night as well. And the really cool thing, too, is that option strategies allow you to completely control your risk by using option spread setups. You decide ahead how much risk you're going to have, and you then structure the trade accordingly. So it's kind of, you know, it's that simple, and that's why, you know, I'm very excited to talk to you guys about income option strategies today. So let's get started, and if you don't mind, hold your questions till the end. I'm going to cover the material, and I'll, you know, try to get around to answering all your questions. So ask yourself this: if you could add a new income stream now, would it change your life? And if the answer is yes, then do you have a plan to achieve that goal? Well, what I put together for you today is a 5-step plan for option income success. And the first step is to learn how to embrace risk for trading opportunities. Step 2 is avoid the #1 option trading mistake that so many beginning option traders will make. Step 3, what are the most important option factors, or the most important option factor for income strategies? Step 4, how does option pricing work? And then step 5, highest probability option strategies for every market. Step 1, though, how to embrace risks for your trading opportunities. Now, trading is all about managing uncertainty, and fear of uncertainty can kill your account, but if you shift your approach to choosing to manage risk instead of uncertainty, you're going to create an account winner. So it's really, if you can think about it, if you have risk and understand the risk, that's really what presents the opportunity to make really good profits. So risk creates volatility, and volatility is really what traders are looking for in the marketplace, and then try to take advantage of it to your favor. So how do you do this? Well, you first off need to have a trading plan. You need to choose and have your risk limits in place. You need to be accountable for your own trading decisions. You need to understand the risk with your strategies you choose to use. Know how to defend any trade you enter within your chosen risk parameters, and choose trades that have defined risks that meet your guidelines. So you're in charge. So basically probably what you've been hearing a lot today from these various speakers is knowing what you're doing going in, and by knowing that, you're going to understand the risk, and you're going to be a lot more successful at what you're doing. So step 2 is avoiding that #1 option trading mistake. Now, option trading has many more advantages than trading stocks, but it's a bit more complicated too. And for the new option trader, it can be a little intimidating when you first start out. Now, that's why many investors decide to begin trading options by buying short-term calls, especially those out-of-the-money calls where the strike price is above the current stock. Since they seem to follow that same old pattern, you follow that pattern of, buy low, sell high. We've had that kind of baked into our brain from all the different commercials you've seen over your life. So this is an example to show you maybe why that's not the best way to, to trade options or to trade in general. So imagine you're bullish on the stock Facebook and it's trading at $65. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike price of $80 at a cost of 15 cents, which would be $15 per option contract. Now, why would you do this? Well, because you can buy a lot of them. So let's do the math on this, and you'll see what I'm talking about. So remember, though, one option contract will control 100 shares of stock. So if you were to purchase 100 shares of Facebook at $65, that would cost you $6,500. But if you took that same $6,500, you could actually buy 433 contracts of the 80 calls and control 43,300 shares of stock. Now, when you look at that math and you do it, it's just unbelievable the type of leverage that you can actually achieve when you use, options. So now imagine Facebook hits $81 within the next 30 days, and those 80 calls that were trading, that you bought at 15 cents or $15 are now at $1.05 or $105 per option contract just prior to its expiration. Now, when you do the math on this, you find out that you can make over $38,000 in a month by doing options versus doing the shares. So at first glance, this kind of leverage is just fantastic. It's awesome. But what you want to look at is not to let that glitter fool you. So the one problem with short-term out-of-the-money calls is that you not only have to be right about the direction the stock moves, but you also have to be right about the timing. Now, that really ratchets up the degree of difficulty. To make a profit, the stock doesn't just need to go past your strike price, but it also must do this within a defined period of time. So in the case of those 80 calls on Facebook, you need the stock to reach $80 within 30 days to make that profit. So you're asking that stock to move more than 23% in less than a month, and this would be a 2 standard deviation move when we're talking about options. And basically it comes down to, well, how many stocks are likely to do that within a month? Well, they're not that many. I mean, we will see examples when some do, but they're not that many out there. So in all probability, the stock would not reach that strike price and the options would expire worthless. So based on probability, and that's what really trading is about probability, and a lot of times we can measure that probability with options using standard deviation. So in this case, there's only about a 5% chance of this stock actually reaching $80 by expiration. So in order to make money on these out-of-the-money calls, you either need to outwit the market or just get plain lucky. And we used to always make the joke on the trading desk is there's an old blues song that if I had no bad luck, I'd have no luck at all. And that's really, what it comes down to trading. You don't get a lot of lucky calls usually, so you really should have a better, clear idea of what you're doing. So, again, being close then means no cigar. So imagine the stock rose to $75 during the 30 days of its option lifetime. Well, you could say you're right about the direction on the stock, but since you were wrong about how far it would go within that specific time frame, you'd still lose your entire investment. So based on that newbie option trader mistake, a really better goal, in my opinion, for every trader would be to select trades based on what provides the most consistent positive return. And one of the best ways to achieve this is by using option strategies that take advantage of selling options for income generation. So by selling options, you're in essence selling time. An option is like a coupon that must be redeemed by expiration date or else it's no longer valid. But how is this all done and what's involved when you're doing these selling strategies? Well, step 3 then comes to the most important option factor for income generation, and that's time. And what is time value? It's used for trading strategies that take advantage of the accelerated time decay of an option into its expiration. So option income strategies are very tied to time value and the impact it has on the option. And time value is also known as extrinsic value, or the extrinsic value of an option. It's the premium a rational investor would pay over its current exercise value, which is called the intrinsic value, based on its potential to increase in value before expiring. Now, this probability is always greater than 0. Thus, an option is always going to be worth more than its current exercise value. Now, time value decays exponentially to 0 by expiration, and the general rule is that it'll lose about 1/3 of its value during the first half of its life and 2/3 in the second. So as an option moves closer to expiring, moving its price requires an increasingly large move in the underlying price of the security. So you're really, if you're buying options getting closer and closer to its expiration, you're really swimming and going against the current. So it becomes a lot harder for those options to make money or be, profitable when you're buying close to expiration. So here's a chart to kind of illustrate this point better. Let me see this. So here's a time decay, and this goes 120 days out. So you start out here and you have very, very slow decay. We call this theta decay in option speak, and it's just very, very small. Now then you get to 60 days out, it starts accelerating a little bit more. 30 days it accelerates more, and then 15 and 7 is just, it's just time value on steroids. So basically you're starting off with maybe even less than a penny time decay, and then it goes to 5 cents time decay as you get further closer to expiration, then 10 cents each and every day. This is every day, and then 50 cents. And so it really accelerates. So if you see this and understand it, then the next thing is, well, then how can I put this to my advantage? So step 4, then to put it to your advantage, you need to understand a little bit more about the option pricing and how it works. So all it is time value times implied volatility times that intrinsic extrinsic value. That's what creates the price of an option. Now, once you know these variables, then you're ready to price that option and know what its option premium should be. So first off, though, again, to know the specifics of it, it's one of the major ones is implied volatility, and this is what the marketplace is implying the volatility of the stock will be in the future, and it's based on the price changes in the option, and it's based on current price. So the one thing that's important to know, if you have implied volatility based on current market situations, when markets come off real hard, that increases volatility. But then the next day, volatility could settle down. So you've got a spike in volatility, which spikes premium. If you know that, then you can take advantage of it, and instead of maybe buying that high price premium, then you can sell it. So these are little things that you learn. And then the second thing is the intrinsic value. That's the amount an option is in the money. And then the extrinsic value, that's the price of an option less that intrinsic value, or the out-of-money portion of it. So that's your extrinsic value or time value. So here's a table to kind of illustrate pricing. So basically it's your time value here times that implied volatility, and that equals your premium. So if this is based on a weekly option, so if you come in on a Thursday, you've got 100% time right here when you first have these options come online, and you take that times implied volatility, we put it in here at 300, and then I kept the intrinsic extrinsic value here constant at 1. So you can see here 300 times 1, you get an option premium of $300. Now if you come in the next day, Friday, and the market just went sideways, did not move at all, you can see you're already down in value by 1/8 right here. So you take that times your implied volatility times that 1, you can see your value of that option premium is going down. Now you come in Monday and you can see what a big dramatic drop off it has even over the weekend. Now it's only worth the time value of it's only 50% of it's left, and even if you have your implied volatility spike to 800 times that 1, you can barely get a move on your implied volatility, or your premium only goes to about 400. So you can see the effects that this time value has on the price of the option. So by understanding that, then as a trader, you can actually take advantage of this time decay and put it to your advantage and start going with the current rather than against it. So step 5 then becomes selecting the right income option strategy. And the goal of every trader really should be to select trades based on what provides the most consistent positive returns, not the biggest return. One of the best ways to achieve this is by knowing the income option strategies that are available and then selecting the ones that are best for your trading style or your trading plan. Now remember, everybody in this room, we're all different. We're all going to have different size capital accounts. We're all going to have different lifestyles. So you might not want to be staring at a screen all day. You might not be able to. You might be working still part-time or whatever, and you can't trade the different hours. So you're going to have to determine your lifestyle, and then you can select the type of strategies and trading strategies to take advantage of all those variables. So that's the cool thing about options. There are a lot of different ways to do it to slice the pie versus if you're just trading, day trading futures or something like that. So that's the thing I like about it. Now the main income strategies, there are basically 5 of them. And I'm going to go through these so you kind of have a feel for each one of them, and then you can kind of think to yourself, okay, this one kind of matches what I want to do based on my capital count, my risk parameters, my lifestyle situation. And the first one is the covered calls. Now this is probably the one that you've probably heard most of and most about, and maybe the ones that you're currently using. The second one is called the calendar spreads. Then you've got the diagonal spreads, long iron condors, and credit spreads. So strategy 1 is that covered call or covered puts. So for monthly income, writing stock options is the basic component of this strategy. Now when you're writing stock options, the premium from the sale is deposited straight into your account the very next business day. So you keep that premium regardless of what the stock does or the option does in the future. So I tell my members and clients that the easy part, though, is writing that option and putting your bank account. The real challenge a lot of times is then keeping that premium in your bank account, because things can go wrong. So if you're in a market that is strong, writing stock covered calls is the way to go. So you want to treat the stock basically as a commodity, traded just to generate that monthly income, just like if you have some real estate rental property. You're really looking each month to get that rent check in your mail and put it in your bank. That's your goal. And it's not that important that you want to own that stock the options are written against, for it to really go up and make a killer profit that way. It's actually going to be to your advantage for that stock to go higher, to be called away, because your main goal is to keep that income. It's for income generation. So, but it is important that you like the stock short-term potential, because you do want that stock to go up and you do want to have that called out, so you know you're going to keep and collect that income and keep it in your bank account. So writing stock covered call options is great. It's a great source of income when the stock market is going up. But what about, you know, times when the stock market has fallen off the cliff? Well, if the market's weak, and there are a couple options that you have. You can either go to cash, but if you're doing this for income, then that's not going to do you any good, putting it in cash. Or the other thing you can do is write what we call covered put options. And writing a stock covered put option basically allows you to profit from a declining stock market. So with stock covered put options, you have already sold the stock short, and then what you do is you just write a put against it to collect the income from the put that you sold. So you don't care if the stock drops sharply, you want it to, and then that way you get to keep the premium from that put that you sold. So the other way to do this, though, in a down market is a strategy to use is what I call, or what you do is basically you're writing call options on inverse funds or bear market ETFs. And this is usually the preference for me. It's just kind of a simpler concept than being short the stock and the margin that you have to put up there. So for a small account, this is the best way to go when you do get into a down market. Now the other good thing is there are plenty of, you know, these inverse or bear ETFs to choose from, and you've got some that are 2x, you know, 2 times the leverage or 3 times the leverage, and these are the type that are excellent for writing premium because you're going to get that extra premium from the leverage. And so some of the better ones, the ones that I like to use, are, you know, QID, which is the QQQ Ultra. That's a really good one. The SDS, which is the Ultra S&P 500, excellent. These are all really tight bid offer spreads. And then the other one is the TWM for the Russell. So, you know, there's a lot to choose from. So when you do get in a down market, you're basically buying that inverse ETF, which is when the market's going down, it's going up, and then you're just writing options against it. And that ETF goes up, you get called out, you keep the premium. So that's the benefit from using the ETFs. Now this is like just, you know, SDS, which is the ultra short S&P 500, and you can see it, you know, when the market's going up, it's going down, and now it's consolidating sideways and potentially starting to push to the upside. So when you look at that chart, it kind of looks like it's flat, bottoming out, maybe going to go up. So if that's the case and it does go up, then you just buy the SDS. You can buy the outright shares at, say, $24.50, something like that, and then you could sell the $25 strike against it, collect that premium, stick it in your bank account. So it's really that simple, but it's getting the direction right and then taking advantage of the strategies out there. Now the second strategy is called the calendar spread. And the calendar spread, it's a really cool strategy. It's a neutral option strategy that profits when the underlying stock is stagnant or trades within a tight price range. A counter call spread profits primarily from that difference in the rate of premium decay between the near-term short option and the long-term options, or even leaps that you can use instead of, you know, buying the security, the stock, or the ETF. And this is possible because, remember from that illustration earlier, the near-term option premiums will decay faster than the long-term premium. So it's what we call a timing spread. So here's an example to illustrate, you know, basically how these work. So you can see this is a price curve, time curve, 60 days out all the way to, you know, 0. And if you, let's say you had, you wanted to do this, and let's say you pick whatever, we'll pick Microsoft, and let's say Microsoft is trading about $35. So you buy the $35 calls. So you'll be long that 60 days out, and then what you're going to do is you're going to sell the same strike value, the $35 call. You're going to go short that call 30 days out. So you're just playing the spread, and this shorter term, short duration option that you're short is going to have that, you know, more severe time decay. It's going to come off fast until it goes to 0, while the long call that you're long 60 days out is going to have that small theta decay, which may be only a penny a day, while this is decreasing 5 cents to 50 cents a day. So that's the concept. It's just a timing spread. And it's a really good strategy, again, when the markets are kind of tending to go sideways, you know, up and down in a sideways pattern, or even if they're just gradually moving up, it's a good strategy, because you can kind of warehouse the stock. You could buy the calls back here, sell the front end against it, collect some premium until the thing starts turning up and taking off, and then you're long the call outright. So it's a good strategy to be aware of and to understand how to use. Now, the next one is the diagonal spreads, and it's a version of the calendar spread. The big difference is you are going to purchase an in-the-money leap option, which is a long-term option, and you're going to buy the option versus buying the stock or an ETF. So you're basically, it's kind of like a covered call, except that you're going to be long a long-term option versus being long that stock. And then what you do is you sell the at-the-money call against it, if we're doing calls, or the out-of-the-money call against it, against that leap option. So here's an example of a trade that we did earlier in the year, and this is a good strategy for when you have a market that's kind of bottoming in a pattern that's kind of a cycle low, I call it, or a bottoming pattern when it's starting to turn up. And earlier in the year, January 2014, you can go, look, crude oil was starting to bottom. So instead of doing crude oil, we went and used the USO ETF, and it was trading at $35 a share. So bought the USO January 2015 $25 calls, and they were roughly going about $10 a contract. So this was in January 2014. Instead of buying the ETF, bought the calls out, the January 2015 calls for $10, and then sold the April 2014 calls against it, the 35 strike, collected $60 a contract, 60 cents or $60 per option contract. So this is kind of what it looked like when you went through the math. So you received, from selling the $35 calls, you got $60 per option contract here. And you put this on as a spread, so you bought immediately. You had also bought the January 2015 USO 25 calls here, and those were going at $10, which would be $1,000 per option contract. So if you take your debit of $1,000 that you paid out, less that credit you received when you sold that 35 April call, then you can see your net capital at risk is $940. So if at expiration the USO is below $35, then you keep that $60 right there, and your capital at risk $940. You just made a 6% return, and if you annualize that out, you know, it's going to be 72. Now the other side of it is if you just did not do this particular strategy, but you just bought the ETF itself. Now this is what it'll look like. You sold the 35 call against the ETF. You collected the $60 per contract there. You bought the ETF for $35 a share. And remember, 100 shares is equivalent to an option, so that's $3,500. So it closed again in this example below 35. So you keep that credit of 60, but your debit was 3,500. So your capital at risk is 3,440 versus your capital at risk here of 940. And on this, your return was $60 over your capital at risk, so it's a 1.7% return. So a big difference, you know, by utilizing that leverage, you get a better, you know, return on your capital, and you have less capital at risk. So it's a good strategy to incorporate in certain situations. The best when it's trading down at the lows. Now it's the January 2015 calls, because this is one. I went out. You go out and you buy the long-term options a year out, so they're going to be cheap. But you're going to want, the way you construct these is you're going to want to buy it with a delta as close to 1 as possible. Yeah. So then strategy 4 is my favorite income credit spread strategies, or the credit spread strategy. This is my favorite to use. And there are 3 basic constructions of this. You've got the bear call credit spread, the bull put credit spread, and the long iron condor. And so basically all it is, the bear call credit spread is a bearish strategy, and you're long a call while simultaneously short a call with a lower strike and in the same month. Then for your bullish strategy, you've got the bull put credit spread, and that's, if the market's going up, this is a bullish strategy to use, and it's short one put with simultaneously you're long a put with a lower strike. So you're going to be short and long, which, the long is your insurance policy to make sure that, you're capped at a maximum loss potential. So this turns out it's a low-cost directional play. And when constructed properly, this spread is an excellent premium collection strategy. Now, the other side of it is the long iron Condor, and this is just basically a combination of the bull put credit spread, which is your long bias, and the bear call credit spread. So it's just combining the two together. Now, there should be equal distance between each strike price, while the underlying stock should be between the two credit spreads or short options. So this is a strategy that's excellent to get really nice premium collection when the markets are sideways. So it's strictly for a sideways type market. So for example, let's say we're looking at Google or whatever it could be, and you're short the 400 call. So you're short that leg, and then your insurance is you buy the call above it. So we'll say the $5 widespread $500 405 call. So that's a $500 spread. And let's say we collected $100 premium collection from selling that 100 call. So we've got that 100. Now we just want this thing at expiration to close below $400, and we'll keep that 100 premium. Now the other part of it is if you think that it's going to be a sideways market, then you could sell the put below it. So we'll say that that whatever this is, it's XYZ company's trading at 390, so we did that bear call credit spread above at 400, and then we're going to sell the bull put credit spread below it, same equal distance. So we're going to sell the 380 put there, buy the 375 as insurance, and again, this is a $500 wide spread. We'll say we collected $100 by selling that 380. We're capped. We've got insurance there in case this thing keeps falling. So, but if it closes between 400 and 380, above 380 and below 400 at the expiration, now we get to keep $200 credit. And the good thing about it is if the market goes nowhere, then that time decay from both the put short and the call short goes to zero, and we keep all that premium. So it's a really beautiful little strategy in a sideways market. Now, the big part of this, though, is the vertical spreads or credit spreads, when used correctly, now they'll provide you the greatest probability of success. And one of the best ways to generate a steady stream of income from this. And it all really comes down to the math. Now, market makers will use the implied volatility of an option to set its price and to forecast the expected implied move of that stock up or down by the expiration of a specific option series. Now, this is referred to in option trading as a one standard deviation move, and it's based strictly on statistics of this. What you're going to see here is the normal distribution curve. So this looks all fancy and everything, but I just wanted to show you the concept that's behind this. So basically what's going to happen, there are statistics based on distribution that price is going to close between two numbers by expiration. Now, by using the implied volatility of the underlying that you're trading, you can calculate and forecast price, its price movement over its option lifetime. And this is a very useful piece of information or tool for determining the price targets to trade against. And the cool thing is it's totally free on any option platform. So this is an example. This is a normal distribution curve that illustrates a one standard deviation move, which says that in this particular stock situation, the stock, you're seeing here the implied volatility is showing a plus or minus 4% move. So what that says is the stock's trading right here at $500 current price, and with the plus or minus by expiration, the implied move is saying that this stock's probability let's say we'll say option expiration is in 10 days. So by 10 days, the probability is that this stock will close between 480 to the low side and 520 to the high side. So it's going to close between these two numbers. Now, this based on the implied move here, that's what we call the one standard deviation move, and this is a 68.2% probability that based on this implied move, implied volatility by 10 days, that's a one standard deviation probability. So 68% of the time, based on this particular stock, Google, whatever it might be, that's currently at $500 in 10 days, is going to close between 480 and 520. So then, if you want to go out even further, if you take what's the probability of it closing over 520, well, that probability is only 15.9%. What's the probability of it closing below 480? That's only 15.9. So you can see that based on the math of probability, you can see why 70% of options bought will expire worthless. And why then it's a really good idea to consider not only buying options from time to time, but also selling options in the appropriate situation. So in this example here, if you were buying the 520 calls, you know, you've got only about a 16% chance that this is going to make money by expiration, versus if you'd sold the 520, your option, your probability of success is going to be much higher. So that's how you look at these credit spreads. So that's just kind of the simple math behind it. Now this is a really good example to show you the two different cases. Now one, this is a bullish option strategy. This is to say when resorts is going to go up, and so you're taking a stand or a view that you think when's going to go up. So you can do two things in this particular situation. You can either buy directional calls to take advantage of it going up, or the second strategy, you can sell a bull put credit spread and still take advantage of it going up. And this is what it's going to look like when you do these two strategies. So this was back in May. The first strategy was buying the at-the-money June 2007 calls, and that cost you at that time was $1,140, $11.40 per contract. And then the second strategy was selling an out-of-the-money bull put credit spread, which was below Wynn's price at the time, and it was below $189. So the low back when Wynn was trading at 207, it had a low earlier, about 4 or 5 days earlier, about $189, and this trade was set up to sell a bull put credit spread that was actually below the $189 strike. So this was 9.5% below where Wynn was trading. So it gives you a good, little bit of cushion there. So here's what it looks like on the, one second here. Sorry about that. So here on the first strategy, you've got infinite upside potential, but your cost was $1,140 per option contract. Now here's what it looks like when Wynn goes down. So Wynn on May 1st, when you bought the option, was $1,140, but then on May 8th, right here, it went up and then it crashed down real hard. So when it crashed down on May 8th, it was trading at $196. So now those options that you paid $1,140 for, now you're in the hole $583 per option contract because of that sell-off. So that's the bad part about those directional options. You've got unlimited upside, but your downside can be pretty ugly. Now this is what it looks like on May 21st right here. It actually recovered, and it was trading at 207 when you first put the options on. Now it's trading at 205 on the 21st. So you're back up only $2 from the original price where you came in, but you're still down $518. Right here you can see your open P&L still down $518. Now the second strategy, you're going to see the big difference and why these credit spreads are such an attractive way to trade, because you can really control your risk. If you look at this particular trade setup here, you've got, this is selling the the 187 puts and buying the 182 right here. So it's a 187, 182 put spread. So down here you can see, okay, you're short the 187 puts and you collected $513 there. It goes in your bank account. Your insurance is you buy below that the 182 puts, and that was $383. So your maximum potential credit you received was 130, so that's your max profit, but you've controlled your loss. You've put your loss as limited to $370. So based on this, if WIN closes above, all it needs to do is close above 187 right here, then you keep that $130, and that's a 35% return on your capital. So it's a lot better kind of structure versus having, you know, the bigger downside risk on a directional call. Now this is what it looks like when you go through it, the different scenarios. So here is on May 8th now. You can see WIN is down here at $196, but your P&L on this, you're only down $38.50 versus that long call being down $583. Big difference. Big way to control your risk and to identify, know exactly what it is. And then on the 21st of May, you know, WIN's come back and it's trading at 205. Well, on this one, your P&L now, you're up $78.50, but you're still down, if you did the long directional calls, you're still down $518. So there's the trade-off. You know, you control your risk, you've got a better risk curve, and it's just a more consistent way to do it. So that's the beauty of the credit spread versus just, you know, going long the stock or long the options itself. And here's two more examples I want to show you. This is actually on Tesla. This was in August. This is what we call the in-the-money bull put credit spread, and this reverses the risk to make it a positive risk ratio. So this is a really cool strategy. Now this is based on a Tesla, and it was breaking out based on our trading model. This is my trading model you can see here. And Tesla was what we call a squeeze, compression squeeze, consolidating sideways, and then based on our model, we could see that the potential direction was for it to break to the upside. So we could have done a couple different things. We could have either bought the stock outright to take advantage of an up move. We could have bought options. We could have bought out-of-the-money options, or we could have done credit spreads, which would really reduce our risk and control. You know, it's a great way to trade for a small capital account to turn it into a bigger account. So instead of buying outright, this is doing a bull put credit spread in the money. So let me show you this, how this turned out. So there's Tesla. It was trading about $230, and it broke out hard that day. Okay, so here was the in-the-money put spread that was done. So this was on August 1st. Tesla was trading at $229, and these were weekly options which would expire at the end of that week. Tesla actually closed at $248. So this was selling a credit spread that was selling the right down here. You were down here below. You were selling the $240 puts right there, and buying the $237.5 puts against it. So it's a $2.50 wide spread. The really cool thing about it, you can see you totally reversed your risk. So here your maximum profit's $217, but the maximum loss that you can lose is $32.50. That's a great risk reward. I mean, that's a 6-to-1. So if this Tesla closes above your short strike, the 240 at close, this 240 strike, you're going to keep that full credit of $217, and that's a 669% return. The thing I love about it is that your risk, capital at risk, is only $32.50 on this trade. So if you get it wrong, that's the most you can lose, and that's the beauty of it. Now, here's what it looked like when it actually closed out. So here was the trade. See, when the trade was put on, P&L was, you know, basically flat, and you had that potential 217. It was taken off, $192. So that was a nice return. The beauty of it, though, is you know what your risk is before you go in. When you go in the trade, You're knowing that the only thing I can lose on this trade would be $32.50 if I did nothing. That's doing nothing. So I like that risk-reward parameter. And here's Tesla, breaks the upside. Here's one more. This was on Baidu about a week ago in the money bull put credit spread. Baidu, the same thing. It was a structure to break out to the upside, which it did. So you could have bought the options, you could have bought the stock. Instead, you could have done a bull put credit spread in the money, and this is what it looked like. This is doing the in the money bull put credit spread. You collect on this trade $181. Your max loss potential, no matter what, if you did nothing, would be $69. So here's the P&L. Go in flat at the expiration. 4 days later, it was above that short strike and $180 profit. So that's the thing. This is to illustrate the difference in trading and how you can take advantage of using option structures to control your risk. So I know there are a lot of questions here about what I just discussed, and you're probably also wanting to find out a lot more about trading option income strategies and credit spreads. So I'm going to answer as many questions as I can here in a few minutes, and also tell you a little bit more about how you can learn a lot more about trading credit spreads as well. But there's only so much time here that I can cover in 1 hour without fire hosing you guys. So first, I'd like to just say thank you for giving me this opportunity to share some of my trading experience and knowledge with you, and hopefully what I shared with you today in this short presentation will make a difference in your trading. I wanted to expose you to the different option strategies out there for income. They're not directional buying, so you can see that there are other ways to skin the cat. So I realize a lot of you don't know me, so I'd also like to share an email I just received from one of my clients.
Hey, Larry, I'm sorry to interrupt, but we do have about 2 minutes left.
Okay.
It was right. Yeah, I'm sorry, it wasn't a full hour. It was 45 minutes.
Okay.
Okay.
Thanks. So anyway, let me just go through here a little bit faster then. So here's some things you can do now. I put together an income course that I did. I did this about 2 weeks ago, and this was just strictly 100% on credit spreads. And if you're interested in this course, it's a 5-hour recorded course in modules. You get the 183 PowerPoint with it, which is great. It's all detailed on different, on the whole course itself with lots of examples. And this is all, just $97. So I've been doing this for over 30 years. So if you're wanting to understand and get into credit spreads or just options in general, this is a real easy way for you to get started. So here's your link. It's powercycletrading.com/pitch. Oh, that's, yeah, pitch, not pick. So let me put that in one more time. It's wrong on the slide. So it's /pitch. And this will give you this course, the whole course, for $97. Now, for the first 50 that sign up here today, you're also going to get, I'm doing a Q&A follow-up on this this coming Wednesday, September 17th. It'll be at 7 p.m. And this will be limited to 50, so I have plenty of space and I can answer the questions. So this is all going to be 100% credit spreads, going through a lot of these different trade setups and explaining in a lot more detail what I just went over, in this presentation. So here it is again. I'll just tell you briefly what's in the course, and this is ready for you right now. So it's going to teach you how to use credit spreads to create low-risk, high-probability trades, credit spreads on stocks and index options, SPX, NDX, how to do those, how to use non-directional credit spreads and when, and we're going to, it goes into a lot on those deep in the money credit spreads that I showed you those 2 examples on. Then also, how to steadily and consistently grow a small account. This is a great way to take a small account, know your risk, and create a large account from these type of spread trade setups. How to defend the trades. I've got 6 defensive strategies that we go through, and then how to use iron condors and when. We go through position size and using credit spreads, and a cool thing, how to take a 70% probability, turn it to 90, and step-by-step guide for executing, and technical analysis to use, and a lot more. So tremendous value, and if you don't like it, I'll give you your money back. You just send me an email, and I'll refund it. But there's so much information in this course that I think you'll definitely get your dollar's worth out of it. Plus, then you'll also get accepted to my Q&A follow-up next this coming Wednesday, actually. So, anytime you take something, a course, you're going to always have questions, and this way I'll give you an opportunity to come in and pick my brain and the Q&A and ask whatever questions you need. So hopefully that'll get you started, and I guarantee this course, we've had so many different people come through it that are doing so much better on their trading by incorporating this along with what they're already doing. Doesn't mean you have to stop what you're doing. This is just another addition to diversify your risk.